Hello and welcome to our market alert video for today, which is September 23rd, 2022. And I'm entitling this market alert video, "Don't be the fool who stays in until the bottom." Now, why am I doing that? Well, because as you guys know, we don't believe that buy and hold is a complete strategy. We think it's incomplete. It's two legs of a three-legged stool. We think you also need to have a sell strategy. So you buy, you hold, and you sell. And we have, of course, our invest and protect strategy, which told our clients, and we counseled our clients, and those of you who have been watching this, to get out of the stock market back in March. So all of this is what we want to avoid, what's going on right now. But why am I entitling that what I am? Well, because the buy and holders, the people that think you should stay in and take a beating and no matter what happens, don't ever sell, they say, don't be the fool who sells at the bottom. And that's why you shouldn't sell. Well, I want to show you why we think that being the fool that stays in until the bottom could be very detrimental to your retirement or your plans to retire. So let me share my screen with you here, and let me show you what I'm talking about. So, oops, let me get there. So this right here is a chart that goes from December 31st of 1999 all the way through the end of March of 2013. And I'll explain in a moment why I chose that time frame. So this right here, and this is the S&P 500 index. I got this on Yahoo Finance, and this is what I call the stock market. So what you can see here is the market from peak to trough here in Y2K went down 49%. Right here at the peak, that was August 28th of 2000. The bottom occurred here on September 30th of 2002. So this down period right here lasted almost 2 years. So if you were sticking in for that because you don't want to be the fool that sells at the bottom, oh my gosh. Now, why do they tell you don't be the fool that sells at the bottom? Because the market will always come back, right? Well, it did come back, but when did it get back to even again? The answer is it got back to even right around here, which was July 2nd of 2007. So it took 7 years to get back to where it was originally. Now, that's a problem on multiple levels. One problem is that if you are retired already and you're taking money out while this is happening to your investments, you're doing what farmers call eating your seed corn. And if you eat enough of your seed corn, then when growth season comes, you may not have enough left to plant. The other thing, of course, is that if you planned on retiring and your investments were doing that, you probably decided, you know what, I'm not going to retire. I'm going to stay working and wait till I get back to even 7 years later so I can retire with the money I thought I was going to retire back here. Now, of course, the same thing here in 2008. So this is the bear market of 2008. And what you can see here, the market peaked right here on October 1st of 2007. Now, of course, our invest and protect strategy said to sell November 27th, 2007. So it was about a month later. So not at the top, almost 2 months later. But still, our strategy said to sell right about in this area right here. The important thing, though, is that as you can see, the market went down and bottomed right here on March 2nd of 2009. That's what, a year and a half later? That's a long time to be experiencing these kind of losses. And yes, if you didn't sell and you stayed in, the market came all the way back. And yes, it got back to even. And that was March 11th of 2013, right about here. So it took 6 years between these two to get back to even, a little under 6 years. But also, if you're looking at this, you're thinking, you know what? The market actually from here all the way to there is 13 years. So if you endured this down and this down during that whole period, your reward is you're basically back to where you were 13 years ago. That's why we don't think that staying in and being the fool that sells at the bottom, that stays in all the way to the bottom is a good idea. It could delay your retirement. It could cause you not to be able to support the lifestyle that you want. There's a lot of reasons why we don't like that idea at all. And as you know, our strategy told our clients, I just mentioned it back in March, to get out of the market and stay out of stocks. We've been out of bonds as well because we think they're both very dangerous right now with the Fed raising interest rates and the economy tanking the way it is. So what do you do about all this? Well, what I would like you to do is to go to our website, rpoa.com, and click on Meet with an Advisor, meet with one of our retirement planners. At the very least, get a second opinion. see how we do what we do and why we think what we think, and see if it's a fit for you. We think time is of the essence because we don't think the worst is over yet. In fact, we think the worst is yet to come. And we don't want that to happen to you. So we look forward to meeting with you. If you come in person, we'll do it virtually or in person. But if you come in person, we'll have our now world famous oatmeal raisin and chocolate chunk cookies waiting for you. They're 1/2 inch thick, 6 inches in diameter. Chocolate chunk, not chip. You don't want to eat chips. They're made with wax. They're gross. You want real chocolate chunk cookies and oatmeal raisin. So come for the cookies and learn how to protect your retirement from what's about to happen in our view. Okay, so thanks for watching this video, and we'll talk soon.